You've probably been told that as long as you earn a solid average return in retirement, you'll be fine. But here's the problem. Two retirees can earn the exact same average return, and one can run out of money a full decade earlier than the other. How is that possible? Because it's not just about how much you earn, it's about when you earn it. And if you hit a market downturn early in retirement, right when you're starting to withdraw from your accounts, you could end up locking in losses, shrinking your portfolio, and putting your entire retirement plan at risk. This is called sequence of return risk. And for retirees in their 60s and early 70s, it's one of the biggest dangers to long-term financial security. The worst part, most people don't even know it's happening until it's too late. Hi, I'm Mark Wisniewski, President of Southern Incomes. If you find this helpful, go ahead and like and subscribe. It helps more people avoid costly mistakes and gives you first access to new strategies every week. In today's video, I'm going to explain exactly what sequence of return risk is, why it's more dangerous now than ever, and most importantly, what you can do to protect your portfolio before the damage is done. Let's get started. Part 1. What is sequence of return risk? Let's start simple. Most people assume that if their portfolio averages, say, 6% or 7% per year in retirement, they're in good shape. But that thinking leaves out one critical detail. You're not just investing anymore, you're withdrawing. And once you start taking money out of the portfolio, the order of returns matters just as much as the average return. Here's what I mean. If the market drops early in your retirement and you're withdrawing at the same time, you're selling investments at a loss to meet your income needs. Now, instead of letting those investments recover, you have permanently reduced your base. That means you have less capital left to grow, even when the market finally rebounds. This is the danger of sequence of return risk. And it's why two people with the same investment strategy and the same average return can completely see different outcomes, depending on when their losses show up. Part 2, a simple example that changes everything. Let me give you a side-by-side example. Imagine two retirees, John and Sarah, and they both retire at 65 with $1 million, and they withdraw $50,000 per year. And importantly, they both earn an average 7% annually over 25 years. But here's the difference. John gets strong market returns for the first 10 years, and then weaker returns later on. Sarah gets the exact same returns, just in reverse order. Poor investments early, poor returns early, and strong later. John's portfolio lasts into his 90s. Sarah runs out of money at age 82. Same investments, same withdrawals, same average return, completely different outcomes. Why? Because Sarah had to sell investments early on while the market was down, locking in losses. By the time the recovery came, she didn't have enough capital left to benefit. That's how sequence of return risk silently erodes your retirement plan. Not with flashy crashes, no Wall Street Journal headline, Sarah lost 10 years of her retirement income due to market losses this year. No, but with the slow drain of early losses and withdrawals compounding over time, you'll feel that income pain soon enough. Part 3, why this risk is worse now than ever before. This isn't just a theoretical risk, it's getting more dangerous. Here's why. 1, retirements are longer. Many people today will spend 25, 35, 40 years in retirement. That's more time for the markets to swing and for poor returns early on to do that lasting damage. 2, there's less of a safety net. Let's face it, pensions are disappearing. Most retirees rely heavily on their portfolio, and that puts more pressure on their investment income and more exposure to volatility. 3, the market is more volatile. With globalization, algorithmic trading, high inflation risks, market swings have become faster and more extreme. Add it all up, and a retiree today is far more likely to face a sharp downturn early in retirement than someone retiring a generation ago. And unfortunately, that's exactly when they could least afford it. Part 4, 3 proven ways to protect yourself. The good news, there are strategies that can help guard against sequence risk without trying to time the market. Let's walk through 3 of them. Number 1, build a safe money buffer. This is where you set aside 2 to 5 years of retirement income in cash, CDs, or short-term fixed income. And this buffer, it gives you breathing room. If the market drops, you draw from the buffer, not from your stocks. That gives your portfolio time to recover before you touch it again. 2, use a dynamic withdrawal strategy. Instead of taking the same amount every year, no matter what, a dynamic strategy adjusts based on how the market performs. So you might pull a little less in a bad year and treat yourself to a little more in a good year. This simple adjustment can help your money last significantly longer. 3, segment your portfolio by a time horizon. This is also called the bucket strategy. Divide your money into 3 buckets. Bucket 1, that's short term, 1 to 3 years for safe cash flow. Bucket 2, midterm, years 3 through 10. That's a balanced investment portfolio. Bucket 3, that's your long-term growth. That's investments that you won't touch for 10 years or more. And by having different assets for different time frames, you avoid being forced to sell your long-term investments when the market dips. This gives you flexibility, stability, and of course, control, the 3 things that you need most in retirement. Here's the bottom line. You cannot control the market, but you can control how you respond to it. And in retirement, that response matters more than ever, because even strong long-term projected returns mean nothing if you're forced to sell low and lock in losses in the wrong years. Sequence of return risk is real, but with the right strategy, cash reserves, flexible withdrawals, segmented buckets, you can protect yourself before it becomes a problem. If you want help building a retirement income plan that shields you from this kind of risk, book a call with me using the link in the description. We'll help you structure your income, investments, and tax strategy so you can retire with confidence, no matter what the market does next. Thanks for watching, and I'll see you in the next one.